Hello there, and welcome back to another edition of Premier Investments in Wealth Management Financial Program. My name is Doug Wagner, and we've got listener question time today. So we'll get into some of the questions that you've sent in to our friends at Premier Investments in Wealth Management at premieriwm.com. Hey, that website, while you're there, click on Get Started and then just answer a couple of questions. They'll provide for you a one-page financial plan. It's called the Premier Vision document. Really simple. Do you know if you're ready for retirement, or do you know if you're ready to pay for your kids' education? Maybe you've got a dream of a lake house or maybe a hunting cabin somewhere in West Texas or Southern Iowa. It doesn't matter where. Whatever your idea is, whatever your financial dream is, head over to Premier Investments in Wealth Management. They will help you put together a financial plan. That's the first step, the bedrock step. premieriwm.com, click Get Started. They'll provide that Premier Vision document and a free no-obligation consultation. They'll sit down with you and leave the document with you when you're done, and you can figure out if you want to work with them. I do. I think that you're going to want to work with them as well. premieriwm.com or call 800-383-6590. Now introducing Wealth Advisor and Vice President of Premier Investments in Wealth Management. He's the new sheriff in town, Sheriff Elias Randall. How you doing?
Very good, Doug.
Good.
Happy to be back on the show.
Yeah. Do you run for re-election anytime soon, Sheriff?
No, never.
No? Okay, that's
Never.
good. That's good. We were talking about politics, not elections. Okay.
No.
President and Wealth Advisor, Premier Investments in Wealth Management. He's got over 21 years of experience in the financial services industry. He's an AIF, an accredited investment fiduciary. He's also the big kahuna. It's Roger Abel. I love that you got the kahuna thing on today. I love that pullover. It just is very...
It's one of my favorite.
Get it.
The black and gray camo.
Yeah, it's awesome. It's fabulous. Roger, Elias, it's listener question time. You guys ready to get it on?
I got a little smile on my face when I saw his listener question. So
Yeah. All right, here we go. Ding,
I
ding,
love
ding.
questions.
Listener question number one. Amy asks, I have a retirement account at work and a stock portfolio. Both are down significantly this year, and I'm tired of losing money. What are the safest options now?
you want to take it? Or you want me?
I can
Little
start.
less handed.
So I'll start. I bet a lot of people feel the same way.
Mm-hmm.
Right? It's
Yeah.
a great time, at least recently, it's been a great time to not log into your investment accounts and take a look at those with all of the volatility that we've been having. So this feeling of tired of losing money, I'm sure that's probably consistent across the board for most investors. Now, what are the safest options is a question here from Amy. So I want to address a couple things. What are you laughing at?
The person walking by
Just
looking for a
random person
Pokemon.
walking by literally outside the window.
Oh,
It's like
Yeah.
sneaking by right behind you. Pretty sure looking for Pokemon.
well, they might,
didn't know that was
they
still
might
a
be out
thing.
in the bushes out front. You never know.
I don't know.
So Amy asks.
So safe. Well, no matter what you decide to do, and this is, I don't know anything about Amy's investing strategy, but
Right.
no matter what you decide to do, there's going to be risk involved with that decision. So I think, and I think really what she's getting at is right now the market's very volatile. So is there a safer option? There certainly are asset classes that are less volatile than the market, but you start to introduce some other risk into your life. And if you're a long-term investor, you could be introducing the opportunity cost, meaning over time, the equity markets have done very well. And typically if folks who are too risk averse to invest that way typically experience a more mediocre result than what you could experience investing in the stock market. And it's probably a good time. If you're wondering, should I be doing something different? It's probably a great time to do some financial planning, because here's really what a financial plan in my mind is. So we have our investments, we have our appetite for risk, we have our goals that we want to achieve. The financial plan is really the glue of the situation. It's going to be a way to put together a strategy that helps you achieve short-term, medium-term, and long-term goals, also with your risk tolerance in mind and the type of investor that you want to be. This question's very hard to answer without any other context and knowing any other work that Amy has done. But, in general, I know if someone's wondering about safest options, that there are definitely investment vehicles out there that are less volatile than the market. But I think you should be doing some financial planning work to really figure out how you're going to do that.
One of the things that's important about this, Roger, is we talk about premier investments and wealth management. It's about educating, inspiring people. It's not just about a product. And that's another thing that comes down to what are the safest options now? Well, it's not about products. It's about how do you put that whole
This is simple.
global view together.
The safest thing to do is get a financial plan, figure out what your risk capacity is. What asset allocation do you need to have to achieve your goals? Once you know what that is, it's really easy to stay on track. I promise you, Amy is probably just like 75% of the other people out there who haven't done a financial plan. They have no clear goals and they don't know why they're investing money. They're investing money because they want to make more money.
Yeah.
Making more money is not a goal. It's not. Because, okay, is it 10% more? Is it 20? Is it 5? How much more? It's not a goal. A goal says, hey, I want to have X amount of income when I retire. So let's say you want $100,000 a year of income. Okay, I have to invest $1,500 a month and I need to have at least 80% in stocks. However the numbers come out, that's a very defined goal. She doesn't have any goals. And I would really caution her during times of volatility to make any knee-jerk reactions. Because as we've talked about before, the biggest days in the market typically come after the most volatility. If you miss out on the 10 best days, you missed out on 20% of the return. Additionally, if I were Amy, I would be asking myself, when am I going to spend this money? If you're under 50, 55, and you're not retiring for 5+ years, now's not the time to make changes. Just not.
Okay.
It could be get more aggressive if you're 30 and have cash, but don't make changes. A good example of this, this happened to Elias here like a week ago. Client left his job, moved to a different state, wanted to do a rollover. Elias said, not right now. It's too volatile. Because to do a rollover, you have to sell the investments.
Yeah.
They send a check or send money in cash to a new institution.
Right.
So this had nothing to do with reducing risk. It's just so volatile. It didn't make any sense to do any transactions. Just let the market calm down before you do anything. I almost equate this to when somebody dies, husband and wife, let's say, and husband, let's say wife. Wife is the driver. She handles all the finances.
Right.
She passes away, leaves the money to the husband. Typically, what do you want to not do the first 6 months? Make any big money decisions.
Yeah.
Let things shake out. When things are volatile, try not to do knee-jerk reactions. And honestly, I'm going to promote it.
Promote it.
Our volatility guide to markets. Go to btwellshow.com and download this. It says 10 actionable ways to help you get into a good mental state and manage volatility. And it's all backed by statistics and white papers and numbers. And the more we can remove human emotion, this is an emotional decision.
Right.
It says right here, I'm tired of losing money. Amy, you haven't lost anything until you actually hit the sell button.
Interesting. Do you know what?
Until you hit the sell button.
That's critical.
Focus on how many shares you have. If you have 1,000 shares of XYZ mutual fund, try to accumulate more shares.
Yeah.
That's good investor behavior. But right now, you haven't lost anything until you hit the sell button.
Do you ever feel like your financial goals are just out of reach? It's time to take control of your future with Premier Investments and Wealth Management, your partner in financial independence. Imagine a financial plan that's as individual as you are. At Premier Investments and Wealth Management, our team of experienced advisors will work closely with you to create a roadmap tailored to your dreams. We'll help simplify complex financial concepts, provide clear guidance, and empower you to make informed decisions. Financial wellness is within your grasp. Visit www.premieriwm.com to schedule a meeting with an experienced advisor today.
That's just listener question 1. I mean, we're in depth this far. That's just listener question 1 here at the Premier Investments in Wealth Management Financial Program. Forbes 2025 Best in State Wealth Management Team. Get in touch with them at premieriwm.com. Click Get Started, answer a few questions, and get your one-page financial plan. It's called the Premier Vision Document. You can keep that. They will even give you a free, no-obligation consultation to go along with it. premieriwm.com, or call 800-383-6590. Listener question number 2. This is from Shayne, who asks, I recently inherited a lump sum of cash from my grandmother. I have about $70,000 still sitting in the bank after paying off some debt and taking a trip with the family. Should I invest it all at once, or should I spread it out over time? Elias Randall?
Shayne, that is a great question. And I think one of the first things people could do, just take a step back and maybe think about what your goals would be for this money you're considering investing. You know, is it to help you purchase a home? Is it to pay for education or college? Is it going to be to start a business? Is it going to be for retirement goals? Because really the most basic thing with investing is, what are my goals for this money, and what is the time horizon? That's always a really great starting place to start to make these decisions. And there's really two main strategies. Now, let's just say you say, well,
Hold on. Talk about why this is important. Like right now, these are more important than ever. Determining which strategy, how to invest this money once you know what you're going to do.
well, the why, let's say, for example, you wanted to beef up a down payment for a home and you just got $70,000. You're not ready to buy the house yet, but you want to invest it. And we'll go back in time a couple months. Let's say it's the end of February 2025, and you think, well, the market's been doing really, really great. I want to buy a house in 2 years, and you take that $70,000 and invest it. How good are you feeling about that decision today in April of 2025? You're probably getting kind of scared and wondering, man, I hope this is worth $70,000 when I'm ready to start spending this. I was hoping to grow this money.
Yeah.
So, you know, for a goal that's 2 years away, investing into the market's probably not the most responsible thing to do with that money. For a goal that's 5, 10, 15, 20 years from now, that probably is a good place to get some more growth on your money.
At least in a lump sum necessarily, because you're talking about really 2 ways that you can put this money into the
two ways
market.
to put the money into the market. Yeah. So, you know, lump sum or what's called dollars cost averaging. And lump sum, you just dump it all in. And that's what Elias was referring to in February. A lot of people would have been greedy and said, hey, I want to get in on this.
Yeah.
They put the lump sum in there and they watched it go down 10%, like really quick.
Right.
Where if someone was nervous about the market, they might say, hey, you know what? Let's dollar cost average this in over the next 6 months, which we did that with some customers in February. January, February, we had some new customers come over. They had money, dollar cost averaging into the market versus just putting it all in because the individual was a little bit nervous about what was going on. Fair enough. Put the money in slowly over time, and then we had different entry points. We're not trying to find the bottom.
Right.
You know, timing the market means you're waiting to try to time the bottom.
Yeah.
Or the top. That's not what dollar cost averaging is. Dollar cost averaging is, hey, we're going to put it in over 6 months. We're going to do it every other week or whatever your strategy is. There's a defined time limit to put the money in. That said, the time frame could get sped up. So in this case, the plan was to dollar cost average the money over 6 months. Well, when we see a 19% decline in the S&P 500, instead of waiting for it to go further, it seemed like a pretty good time to get a lot more of the money in. We called the customer and told them what's going on. They're like, we think it's a great idea. And they were really happy because it shielded their portfolio from some short-term losses. That said, in the long term, most of the time the lump sum wins.
Yeah.
Because you get your money in. And the longer you have it in the market, typically the better you do because markets typically go up.
And it's coupon clipping. I mean, really what it comes down to it is that when you were down there, you've got the markets 15 to 20% down, it's a 15 to 20% off sale. And who doesn't love a 15 to 20% off sale?
Well, and there's a couple of things you could have done.
Yeah.
And I did these. backdoor Roth, maxed out my whole 2025, increased my 401k contribution to max it out as fast as I could. I gave up my paycheck to put it all into the market for a few weeks to get my 401k maxed out. Unfortunately, I'm not going to get all the contributions in at the price I would have liked.
Yeah.
But it's still lower than it was 2 months ago, and I'm okay with that.
Yeah.
Doug, how many, and we've done this a lot on the different programs we do with you, but how many times have you seen a chart that we bring and it shows, hey, had you invested 10,000 during the .com bubble, it'll be worth X today.
Yeah.
Or during, the September 11th attacks or the great financial crisis.
Right.
What do you think the odds are 10 years from now? We'll have a chart that shows people, had you invested X during, we'll call it the great tariff scare of 2025, whatever you want, the bear market of 25, whatever you want to refer to it as, and then show people 10 years from now, be able to show the results of that. How many people would be upset? Just if you're just going to make a bet that people would be upset with that decision.
I think very few people. I mean, I am not an odds maker, but I'm going to say 95 people out of 100 would be happy because you've shown me these charts say over the years, there's only one 10-year period that you can think of in the modern era since stock markets are here that the markets have not appreciated.
That is true.
Okay, those are facts.
And
those are things.
and so we can, there's really those two main strategies. I think really one of the key takeaways is
Here's the takeaway.
being invested and staying invested is going to work over long periods of time.
Here's the takeaway. Peak anxiety, March 13th, 2009. That's the height of the financial crisis. You guys know what the S&P 500 traded? 732 points. 756.65.
Yeah.
It's 50, as I'm looking at this, it's 53.95 today. So
Yeah, I was
at
just
that
looking for
time,
that.
every single person is saying there is no, people are bailing out of the market. World's coming to an end. Never seen anything like it. All of the same things people said during COVID, all the same things people are saying today. 756. How much would you like to buy today? You'd give up
that
everything
price?
you have to buy it.
It's like Back to the Future now. Let's do.
It's a 7X. It's 7 times higher today.
Yeah.
In what?
16?
17 years.
Yeah, 16, 17 years.
Who wouldn't take 7X over 17 years? Now I'm going to the bottom, so it's exacerbated. But point is, you made the point. It likely, we're going to look back and be like, man, I wish I would have bought some. Everybody will.
Yeah. And
Now,
if you're nervous.
And if we don't, it is what it is.
Yeah.
But likely over the next 10 years, markets will go higher.
And Shayne, if you're nervous, you could do both, a hybrid where you can do dollar cost averaging and you can do lump sum in. It just comes down to having a plan. For my friends at Premier Investments and Wealth Management, premieriwm.com is the website. Click Get Started, answer a few questions. They'll provide the Premier Vision document for you. It's a one-page financial plan. You can have 120. Said there's lots of stuff behind it, but here, take a look at this one-page financial plan. I think it's something that's going to convince you that you need to be prepared for retirement, for your future, for your children's education, whatever your financial future entails. PremierIWM.com or call to make your appointment at 800-383-6590 at Premier Investments in Wealth Management, a Forbes 2025 Best in State Wealth Management Team. Listener question number 3 from Noah said, I work for a large company. We make ARCs. He didn't say that really. Currently, about 50% of my 401k is invested in company stock. It's good company. I believe it's in long-term growth potential, but my wife thinks that I shouldn't have that much allocated in company stock. What's your advice?
I love this
Say
question.
yes, honey, you are correct.
Yeah, there you go. Yeah.
She's on to something.
100%. So I think this is best answered by doing a Jonas, and that's asking an upside down question. If you lost 50% of your retirement today, how would you feel? And you never had the chance for it to come back. Like
Right.
50% was gone because that is the risk you run with an individual stock. You do run the risk that an individual stock can go to zero and never recover. Technically, could a stock index or a mutual fund do that? Yes, but it's so obscurely unlikely that, I
Yeah.
mean, that means all of the earnings for all companies is zero. Every company went out of business.
Yeah.
So I think your spouse is onto something. That said, I do understand having pride in the company that you work for. And I don't think owning stock in a company that you work for is bad. So we typically recommend no more than 10 to 15% into an individual stock, company stock. You know, if you lost 10%, if that stock went to zero, it was 10% of your portfolio, it is not cataclysmic.
Yeah.
But if we look back through history, and very few large cap companies actually go to zero. You look back through history, very few have actually gone to zero, but we can name a couple. Enron. Everybody thought Enron stock was great until Enron stock wasn't great.
Yeah.
MCI. MCI was, you know, that was a telecommunications company. A lot of seniors own that because it paid a good dividend.
Yeah.
It went to zero. So I think the best thing to do is, can I afford to have this go to zero?
Right.
And what's the number I'm willing to put on the floor in my living room and light on fire and not get back? No, seriously. But
No, I like that analogy. It's like,
it's the analogy I use with my wife.
Right.
We're going to buy a big purchase. Are you willing to light that money on fire?
Yeah.
And if you're not, then you shouldn't have it.
Do you ever feel like your financial goals are just out of reach? It's time to take control of your future with Premier Investments and Wealth Management, your partner in financial independence. Imagine a financial plan that's as individual as you are. At Premier Investments and Wealth Management, our team of experienced advisors will work closely with you to create a roadmap tailored to your dreams. We'll help simplify complex financial concepts, provide clear guidance, and empower you to make informed decisions. Financial wellness is within your grasp. Visit www.premieriwm.com to schedule a meeting with an experienced advisor today.
this is interesting because I was talking with a relative of mine. He knows somebody, and I knew them too, but this was back in the 1950s. This person started working for a major oil company. And because they didn't need her income to make it, they decided to take all of her income in stock.
For the company,
Yeah, they took all of her income in company stock.
how'd that work out for them?
It worked out very well, but I'm just thinking to myself, is like, that's the one thing that you'd say is like you said, if this goes away.
Here's what this is, though. So one thing I think people need to recognize about investing is when you're diversified, you're actually admitting defeat. You're saying, I can't pick the best stock or the best asset class on a regular basis. That's true. Like when you diversify, because your whole goal is that if some stuff goes down, other stuff is going to go up. If you think about how some vast wealth in this country has been created, most of the time, the wealthiest individuals in the world had highly concentrated stock positions, typically in their own business.
Right.
But for all of the people out there who've accomplished and built wealth that way, there's so many more that have been destroyed by doing it.
Yeah.
So your point
Sometimes
is
the
it
same
worked
people.
out for it worked out for those individuals, and I commend them for it.
Yeah.
But they took a very, very large risk. Now that said, back to very few large cap companies have actually went to zero.
Yeah.
If you're buying large companies, the risk is still less, but it still could massively underperform the overall index.
Well, the critical thing is making sure you have a financial plan for the entire thing. I mean, ultimately, once again, it's like this gets back to the 50% of his 401k. I mean, there are a lot of people who think 401k is like monopoly money. I mean, it sounds goofy to say that, but you say IRA and people start breaking out in a cold sweat. You say 401k, they're like, whatever, because they see them as two different things.
They're just they are two different tax
What?
codes.
Right.
It.
That's it. But they're both investment vehicles.
The investments can own the same things, but they're two different tax codes.
I know. It's amazing.
Well, yeah, and I think in a situation like this, this obviously the person feels good about the company and their growth potential and all that. So, I don't think it should be viewed as I'm taking a bet against my company to just have less exposure. I just think it's really more of managing your risk through diversifying and just because you also enter in, if that company, one, you could lose half your retirement in that situation. You're also going to lose your job if they go out of business.
And
So that's another risk you have.
are
out
you
there.
the only employee in that company? I mean, really, because if you're not the only employee in that company, then they're betting on other people other than you too. So they've diversified. Why do you not diversify? You know what? There's a lot of good Q&A that can happen when you sit down and you start looking through these Premier Investments in Wealth Management videos and the podcasts that are out there, premieriwm.com. And it's important that you do so. Take advantage of this as all the information's out there, because right now it's like taking in water. It's like taking water from a fire hose at this point. There's so much information that's blasted out there. Problem with it is that there's so much of it that is maybe false, it's incendiary. This is where that media filter comes into effect, Roger.
Right now is more important to have a media filter than ever before, because there is a lot of noise, and you got to figure out where you're getting your information, what's real and what's not. How do you vet it? And I think, how do you vet it in a nonpartisan way? We talked in the previous show that people become partisan with their portfolio, which is really sad. But just know where you're getting your media. Figure out what's good information and what's bad. That's what I do.
Work your
I have
way
4
through it.
places I get it from. And like I said, it's the places that I believe remove politics from both sides.
Yeah. Premier Investments in Wealth Management at premieriwm.com. Go to the website. Lots of good downloadable information that's there for you. You can click Get Started. Once you get to the webpage, answer a few questions. They'll provide for you a one-page financial plan. They call it the Premier Vision document. And from there, are you ready for retirement? Whatever your financial needs are for the future, you need to have a plan, and that's that first step is go to premieriwm.com, click Get Started. You can make an appointment online if you would like to. You can see a little bit more about Roger, Elias, and the rest of the staff at Premier Investments in Wealth Management, or you can call to make your appointment today, 800-383-6590. Make sure while you're there at the website, or you give them a call, ask them about that magazine that they have about volatility. It's important that you have a good understanding. Roger's going to hold it up right here, and you can get that at premieriwm.com. For Roger Abel, for Elias Randall, my name is Doug Wagner. We'll talk to you again next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available and rollovers are permitted, roll over to an IRA, or cash out the account value. Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.